Make I know where I come from. There's no time to shalaye. Oh, only come from my medulla, from my It don't gong. To the Montana, Lamono. See this swag, I want down.
Have you ever looked at someone else's financial decisions and just thought, are they crazy? What were they thinking?
Oh, all the time.
Maybe it's a friend who, I don't know, bought a designer dog kennel that cost more than your first car. Or maybe a relative who swore by a stock tip they got from their psychic.
Yeah.
We all do it, right? We see these choices and they just don't compute. They seem illogical.
Completely.
Well, today in this deep dive, we're going to explore why people make the financial decisions they do. Even the ones that seem completely baffling to outsiders.
Right.
We've pulled together some really fascinating sources that unpack the surprising truths about our money mindsets. Our mission really is to get to the bottom of why what seems crazy to you makes perfect sense to someone else.
And the core premise here, it's simple, but it's pretty powerful. No one's crazy.
Right.
Our goal today is really to understand, not to judge. Because it's crucial to realize that our unique experiences shape our views about money far more profoundly than we often acknowledge.
So that core idea, no one's crazy, it sounds simple.
Yeah.
But it really does make you rethink things. How do we start to, unravel why that holds true?
Well, it really comes down to this. Everyone's financial lessons are just wildly different because their experiences are unique.
Right.
And what you've personally experienced is, frankly, far more compelling than anything you just learned secondhand.
Yeah, that makes sense.
Think about it. We all kind of go through life anchored to a set of views about how money works. And these views, they vary dramatically from person to person.
So like different starting points.
Exactly. For instance, someone who grew up in severe poverty, they perceive risk and reward in ways the child of a wealthy banker just cannot fathom. It's a different world.
Right.
Or, consider someone who grew up during a period of really high inflation. They've experienced something tangible that someone who's only known stable prices just hasn't. And the stockbroker who lost everything in the Great Depression, their understanding is, well, it's incomparable to a tech worker who maybe flourished in the booming late 1990s. The list goes on and on. These unique experiences are truly endless.
So when we see people, say, on opposite sides of a major financial debate, like about recessions or investing strategies, it's not necessarily a battle of intellect.
And a bit mind-blowing is that our personal experiences with money might make up this tiny, tiny fraction, like 0.000000001% of what's happened in the world.
Wow, that's small.
Yeah, minuscule. But they account for something like 80% of how we think the world works.
90%, that's huge.
It is, and this raises a really important point about what you might call the unrecreatable power of fear and uncertainty.
The unrecreatable power of fear and uncertainty.
Okay.
That's a strong phrase. Can you give us an example?
Sure. Take John F. Kennedy. When he was running for president, a reporter asked him what he remembered about the Great Depression. And Kennedy basically said he had no firsthand knowledge. His family was incredibly wealthy. They actually had bigger houses, more servants, traveled more during that time.
So he didn't experience the hardship?
Not at all. He only learned about the Depression by, reading about it at Harvard. And this was actually a major point in the 1960 election against Hubert Humphrey, who had lived through it.
Right. Humphrey had that direct experience.
Exactly. And the challenge for all of us is that no amount of studying or open-mindedness can truly recreate the emotional weight of living through that kind of economic fear and uncertainty. You can read all about what it was like to lose everything, but you don't have the emotional scars, right? Spreadsheets can model how often stock markets decline historically.
Sure, you can see the numbers.
But they can't model that feeling of looking at your kids and wondering if you've made a mistake that's going to impact their lives.
Yeah, that's a different level entirely.
It is. As the investor Michael Batnick puts it, some lessons have to be experienced before they can be understood. And we are all, in different ways, kind of victims of that truth.
That makes so much sense when you put it like that. We've talked a lot about the anecdotal evidence and the logic behind it, but is there actual data? Has anyone formally studied how our personal histories impact our financial decisions?
Oh, absolutely. Back in 2006, two economists, Ulrich Mulmendier and Stefan Nagel, from the National Bureau of Economic Research, which is, a major nonprofit research institution, they dug through 50 years of the survey of consumer finances.
50 years. Wow. That's a lot of data. And what did they find? Was it as compelling as the stories?
I'd say so. Their findings were pretty profound. They discovered that people's investment decisions are strongly anchored to the experiences those investors had in their own generation, especially experiences early in their adult life.
Anchored. Okay, so those early years really stick.
They really do. For example, if you grew up when inflation was high, you tended to invest less in bonds later in life compared to people who experienced low inflation.
Right, because bonds got hammered.
Exactly. Conversely, if you grew up during a strong stock market, you tended to invest more in stocks later in life.
Makes intuitive sense.
And here's the crucial part. They concluded that individual investors' willingness to bear risk depends on personal history, not necessarily on intelligence or education or even financial sophistication.
So it really boils down to luck of the draw sometimes. When and where you were born.
That seems to be a huge factor, often just the dumb luck of when and where you were born.
So does that mean someone who lived through, say, 2008 or the dot-com bust might just inherently react differently to market downturns today, even if they're a super sophisticated investor now?
Well, that's what the research implies. It's like those early experiences get deeply ingrained.
But what about, education? Financial literacy? Surely, with enough knowledge, someone can overcome those early biases, right? Can you learn your way out of it?
You'd certainly hope so, and education helps, no doubt. But the research suggests these early experiences are incredibly persistent, maybe more than we think.
Mm-hmm.
And you see this play out in the real world. Like the Financial Times interviewed the famous bond manager Bill Gross back in 2019.
Oh, yeah, the bond king.
Right. And he openly admitted he probably wouldn't be where he is today if he'd been born maybe a decade earlier or later. His career just happened to coincide almost perfectly with this generational collapse in interest rates.
Ah, so falling rates made bonds look amazing.
Exactly. It made bonds seem like wealth-generating machines to him. But, to his father's generation, who'd lived through higher inflation, those same bonds might have seemed like wealth incinerators.
Wow. Same asset, totally different perception based purely on timing.
It's all about perspective shaped by experience, even for the most brilliant financial minds.
That dumb luck of birth year is really powerful. Can you give us some more concrete examples of how different birth years would just radically shift someone's financial view?
Yeah, absolutely. So say you were born in 1970.
Okay.
During your teens and 20s, those really formative years, the S&P 500 increased almost tenfold, even after adjusting for inflation.
Tenfold. That's incredible.
Right. That's an amazing foundational experience with stocks seeming like a sure thing. But if you were born, say, in 1990, the market was very, very different during your formative years. You saw the dot-com bust, then 2008. It leads to a completely different view on how the stock market works.
Totally different lesson learned.
Or think about inflation. If you were born in 1960s America, prices more than tripled during your teens and 20s. You might remember gas lines, stagflation.
And so as my parents told me.
Exactly. But if you were born in 1990, inflation has been consistently low your entire life. Yeah. It's probably never really crossed your mind as a major economic threat. It's just background noise.
And this goes beyond just birth year, right? You mentioned socioeconomic factors too.
Oh, absolutely. The scope broadens dramatically there. Take November 2009, deep in the Great Recession. America's nationwide unemployment was around 10%.
Which was high.
Very high. But it wasn't 10% for everyone. For African-American males aged 16 to 19 without a high school diploma, that rate was nearly 49%.
49%? That's staggering.
It's almost unbelievable. Now, contrast that with, say, Caucasian females over 45 with a college degree. Their unemployment rate was just 4%.
Wow. Same country, same time, vastly different economic realities.
Precisely. And these differences extend globally, too. Think about World War II.
Okay.
Think about the impact on German and Japanese stock markets and economies. Entire regions bombed out. German farms, post-war, could only produce enough food for maybe 1,000 calories a day per person for a while.
Devastation.
Total devastation. Now, compare that to the U.S. economy during that same period. It was booming. The stock market more than doubled from 41 through 45.
Right. The war effort boosted the U.S. economy.
Exactly. So what this all tells us is, well, you shouldn't expect members of these vastly different groups to think the same way about money or respond to financial information identically. or even trust the same sources of advice.
Because their fundamental view of money was formed in completely different worlds.
That's it. And when that's the case, a view that one group finds outrageous or crazy can make perfect sense to another.
Sometimes the numbers and theories, they only tell part of the story.
Yeah.
To really get these profound differences in perspective, you almost have to look at individual experiences, right?
You do.
That Foxconn's sweatshop story you mentioned earlier, this seems like a perfect example of this. Tell us about that again.
Yeah, it really is. So the New York Times ran a piece, detailing the working conditions at Foxconn, the huge Taiwanese electronics manufacturer.
Right, making iPhones and other things.
Exactly. And American readers were, quite rightly, upset by the often atrocious conditions described. Long hours, low pay, tough environment.
Yeah, I remember the reaction.
But what's Americans call sweatshops. He acknowledged it all hard work, long hours, small wages, poor conditions. No argument there. But then he revealed something just eye-opening. Before working at Foxconn, his aunt had been a prostitute.
Oh, wow.
Yeah. And so, from her perspective, the factory job, despite all its challenges that seem horrific to us, was a profound improvement.
An improvement because
it meant her body wasn't being exploited anymore in the same way. It gave her a different kind of maybe dignity or control, even within those harsh factory conditions.
it completely reframes it, doesn't it? It really challenges our immediate sort of black and white thinking.
It absolutely does. It shows how relative poor conditions or improvement can be depending on your starting point and your alternatives.
That anecdote is incredibly powerful. It really hammers home the point that every financial decision a person makes, whether it seems logical to us or not, actually makes sense to them in that moment.
Exactly. It checks the boxes they need to check based on their reality.
They tell themselves a story about what they're doing and why, and that story is shaped by their own unique experiences. They might be misinformed, sure, or have incomplete information, maybe be bad at math or misjudge the consequences.
Oh, possible.
But in their mind, in that moment, it works. It makes sense.
Which brings up an important question. If this is true, how do we explain something that seems so clearly crazy to many of us, like buying lottery tickets?
Ah, yeah, the lottery. Good example.
The stats are pretty wild. Americans spend more on lottery tickets than on movies, video games, music, sporting events, and books combined.
Combined. That's unbelievable.
And who buys them? It's primarily low-income households. They spend, on average, about $412 a year. That's 4 times the amount spent by the highest income groups.
$400.
Yeah.
And wasn't there a stat about emergency funds?
Yes. Shockingly, 40% of Americans can't come up with $400 in an emergency.
So the people buying $400 in lottery tickets are often the same people who don't have that tiny safety net. That does seem crazy on the surface.
It really does.
When I first looked at those lottery stats, I admit I found it baffling. It just didn't compute with conventional financial wisdom,
Of course.
But then, if you really try, if you strain a little to step into that mindset, the why starts to maybe emerge, doesn't it?
How so?
Well, you can almost imagine their reasoning. It might go something like this. Look, we live paycheck to paycheck. Saving, that seems completely out of reach. Our prospects for really getting ahead or even putting our kids through college without just crippling debt, they feel slim.
A feeling of being stuck.
Yeah. And much of the good stuff that you people, people who read finance books, either have now or have a pretty good chance of getting. Well, we don't. We just don't see a path.
Okay.
So buying a lottery ticket, that's the only time in our lives we can hold a tangible dream of getting the good stuff that you already have and maybe take for granted.
Yeah.
We are paying for a dream.
Paying for a dream.
And you may not understand that because you are already living a dream, or at least have a realistic shot at it. That's why we buy more tickets than you do.
Now look, you don't have to agree with that reasoning, right? Buying lottery tickets when you're broke is still, generally speaking, a bad financial move.
Objectively, yes.
But understanding the why, understanding that narrative they're telling themselves, it bridges the gap. It makes the behavior comprehensible, even if not advisable.
Right. It shifts from crazy to understandable, given their perspective.
Exactly. And the truth is, very few people make major financial decisions purely with a spreadsheet. They make them at the dinner table or maybe in a company meeting where personal history, their unique view of the world, ego, pride, marketing, odd incentives, it's all scrambled together.
Scrambled together into a narrative that works for them.
Precisely.
This leads us to another really crucial point, doesn't it? Something else that helps explain why money decisions are so difficult. and why there's so much perceived misbehavior out there.
Yes, and it's about how new all of this is.
New, but money's ancient, right? King Aliada's Lydia, 600 BC.
Money itself, yes, ancient. Coins, currency, that's been around for millennia. But the personal responsibility for managing it, for saving and investing for your own future, that's actually a very, very recent development in human history.
Okay, tell me more about that. How new are we talking?
Well, what's fascinating here is just how new some of these core concepts really are. Take retirement, for example.
Okay, retirement.
Yeah.
Seems pretty standard now.
Now, yes, but before World War II, most Americans simply worked until they died. That was the expectation, and it was the reality.
No golden years relaxing.
Not for most. Social Security was established, sure, but its initial benefits back in 1940 were tiny. Ida Mae Fuller's first check, $22.54.
$22.
Yeah. And it wasn't until the 1980s that the average Social Security check, even adjusted for inflation, consistently exceeded $1,000 a month. So the idea that everyone should save and invest their own money to ensure a dignified retirement, that only really took hold in the 1980s.
The 80s. That's surprisingly recent.
It really is. And to reiterate how new this is, the 401k, right?
Yeah.
The backbone of American retirement savings now. It didn't even exist until 1978.
Wow.
And the Roth IRA, born in 1998, if it were a person, it would barely be old enough to drink legally in the U.S.
That's incredible. So these cornerstones of modern personal finance are younger than many of the people using them.
Absolutely. And the same pattern holds for college education.
How so?
Well, the share of Americans over 25 with a bachelor's degree went from less than 1 in 20 back in 1940
Tiny percentage.
to about 1 in 4 by 2015. And during that same time, average tuition rose more than fourfold adjusted for inflation.
So more people going and costing way more very quickly.
Exactly. Something that big and important hitting society that fast. It helps explain why so many people have made maybe poor decisions with student loans over the last 20 years. There just aren't decades and decades of accumulated experience for society to learn from.
We're essentially winging it.
We're winging it. And modern investment vehicles, also very new. Broad market index funds, the easy way to invest across tons of companies. They're less than 50 years old.
Less than 50.
Hedge funds, they really only took off in the last 25 years or so. Even widespread consumer debt, mortgages, credit cards, car loans, didn't truly explode until after World War II, partly spurred by things like the GI Bill.
It's kind of like that analogy. Dogs were domesticated, Brett, 10,000 years ago, and they still retain some behaviors from their wild ancestors.
Right.
And here we are with maybe only 20 to 50 years of real, widespread experience in this modern financial system.
Yeah, 50 years is generous for some of this stuff.
And we expect ourselves and each other to be perfectly acclimated, to make all the right decisions all the time. It's almost comical when you frame it that way.
It really is. And for a topic like money, which is so heavily influenced by emotion versus pure fact, this newness, it's a major problem and helps explain why we don't always do what we're quote-unquote supposed to with money.
Okay, so let's try and wrap this up. To summarize our deep dive today, we all do things with money that might seem crazy to others, but it's often because we're all relatively new to this complex game, and we're operating from our own unique set of experiences that fundamentally shapes our perspective.
That's the core of it.
So no one is truly crazy. We're all just making decisions that make sense to us in that specific moment, given the story we've built from our own lives.
Right. And maybe a final thought for you to consider as you go about your week. Think about someone whose financial decisions you might judge, maybe someone you see as irrational.
Okay.
Instead of just dismissing them outright, take a moment, ask yourself, what personal experiences might have shaped their unique story? What could make those choices seem perfectly logical to them?
Flipping the perspective.
Exactly. And then maybe ask, what does that contemplation tell you about the assumptions you might be making about money and about how the world works?
Okay, so there's this great story. Kurt Vonnegut, the writer, he's at a party on Shelter Island with his friend Joseph Heller, Catch-22 Heller.
Legendary.
And Vonnegut points out that their host, some hedge fund guy, made more money in one day than Heller got from Catch-22 over its entire history.
Wow. Yeah.
And Heller just says, yes, but I have something he will never have. Pauses. Enough.
Enough. Such a powerful word. Really cuts to the core of it, doesn't it?
It really does. And that's what we're diving into today, this whole idea of enough, how crucial it is, how often we miss it, especially with money and success.
And the dangers, right? The surprising dangers when you don't know when enough is enough.
Yeah.
Even for people who, seem to have absolutely everything.
Exactly. Why do incredibly rich people sometimes risk it all chasing just more? That's the big question we're tackling.
Yeah. And we've pulled together some really compelling real-world stories, examples, and, observations that shed light on, well, human nature, ambition, our whole relationship with wealth.
The goal is to kind of unpack why this happens, not just what happened. Look at the psychology, the financial thinking, and what lessons you might take away.
Makes sense.
Okay, so let's dig in. First up, Rajat Gupta. Now, here's someone whose story is just remarkable. He started in Kolkata, really tough background, orphaned as a teenager.
A genuinely humble beginning. Not exactly born on third base.
Not even close.
Yeah.
Couldn't see the stadium, like we said. But his rise, absolutely phenomenal. I mean,
Yeah.
mid-40s, he's CEO of McKinsey.
The most prestigious consulting firm in the world, arguably.
And he doesn't just retire quietly. He gets involved with the UN, the World Economic Forum, philanthropy with Bill Gates, sits on boards for 5 huge companies.
So incredible success, and obviously with that comes, well, serious wealth. By 2008, he's reportedly worth $100 million.
$100 million.
Just pause on that. Even a conservative 5% return on that, that's nearly $600 an hour.
Wow.
24 hours a day, whether he's working or sleeping.
Right. So he has the success, the money, the prestige, the power, freedom. You have to ask, what more could he possibly need or, want? What was driving him?
That's the $1 million question. Or, I guess, the $100 million question.
Right. It seems almost irrational. But apparently what he wanted wasn't just to be a centimillionaire. Rajat Gupta aimed higher. He wanted to be a billionaire.
He's on the Goldman Sachs board, surrounded by these titans of finance.
And he felt like that circle, the Goldman circle, was just the hundreds of millions, not the real elite, the billionaire circle. That's how he saw it.
Which is an incredible perspective to have when you're already worth $100 million.
It really is. So fast forward to 2008. The financial crisis is hitting. Warren Buffett steps in, plans to invest $5 billion into Goldman Sachs to stabilize things.
Huge deal. Massive news.
And Gupta, as a board member, finds out before anyone else. And then, it's critical, 16 seconds after hearing about the deal in a board call, he hangs up and calls Rajaratnam, a hedge fund manager.
16 seconds. Wow.
Rajaratnam immediately goes and buys 175,000 shares of Goldman Sachs.
Just before the news breaks.
Exactly. Hours later, the Buffett deal is announced, Goldman stock surges, and Rajaratnam makes a cool $1 million. Just like that.
Instant profit based on inside information.
And the end result, utterly tragic. Both Gupta and Rajaratnam end up in prison for insider trading, careers gone, reputations destroyed.
Just thrown away. All for what felt like more.
It's a stark example. Reaching for more when you already have so much. But then there's Bernie Madoff. Everyone knows his name, right? The Ponzi scheme guy.
Synonymous with financial fraud, yeah.
But what often gets lost, I think, is that Madoff, kind of like Gupta in a way, was actually a massively successful, legitimate businessman before it all went wrong.
That's a really important point. People forget that. His market-making firm, Bernard L. Madoff Investment Securities, it was huge. Very profitable.
How profitable are we talking?
Well, he was a pioneer in electronic trading, basically taking volume away from the New York Stock Exchange floor. His firm handled something like 9% of the NYSE's average daily volume off exchange.
Wow, 9%.
Yeah. And that legitimate business, it was making him somewhere between $25 million and $50 million a year, every year, legally.
25 to 50 million
a
year. And still, he builds this massive Ponzi scheme on the side.
Exactly. Which brings us back to that core question for both Gupta and Madoff, right?
Yeah. Why? Why would people worth hundreds of millions, with all the prestige, power, freedom you could imagine, why risk everything for more money?
It's not like stealing bread because you're starving. This is something else entirely.
It feels fundamentally different. What does it tell us about, I don't know, the psychology of wealth or maybe just human nature?
Well, it's fascinating because you see versions of this same thinking even when it's not criminal. Take long-term capital management, LTCM, that hedge fund that blew up spectacularly in '98.
Yeah, I remember that. Nobel laureates on their board, super geniuses.
Exactly. And the traders themselves, they were personally loaded. Tens, hundreds of millions each. Most of their own money was tied up in the fund.
Okay.
But they chased more. They leveraged themselves to the absolute hilt, taking on enormous risk. And then they lost it all, wiped out.
And this was in 1998. Not exactly a terrible market then.
No. It was in the middle of a huge bull market, a strong economy. It wasn't market conditions that ruined them. It was their own insatiable desire for more, leading to unbearable risk.
Warren Buffett had something to say about LTCM, didn't he? He always has the perfect line.
He really does.
Right.
He said, to make money they didn't have and didn't need, they risked what they did have and did need.
Oof.
And that's foolish. It is just plain foolish. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense.
Plain foolish.
Yeah.
It really cuts through it. So these stories, Gupta, Madoff, LTCM, they all seem to point towards this dangerous pursuit of more. So what's the takeaway? Maybe the first big insight here is that the hardest financial skill isn't making money. It's getting the goalpost to stop moving.
That's a great way to put it. Because what happens? Your results go up, but your expectations often go up just as fast, or maybe even faster.
So you never actually feel like you're getting ahead.
Exactly. You put in extra effort, get more money, more power, whatever, but you just want more of it. Ambition outpaces satisfaction.
And the goalpost just keeps shifting further away.
Right, and then you feel like you're falling behind even though you're objectively doing great. And that feeling, that's what can push you to take bigger and bigger risks to try and catch up.
It's like modern capitalism is brilliant at creating wealth and envy.
They definitely feed each other. Wanting to keep up, wanting to surpass others, that can drive hard work. But, life's no fun if you never feel like you have enough. Happiness, maybe it really is just results minus expectations.
And a huge driver of those rising expectations seems to be, well, looking around at what other people have.
Yeah.
Social comparison.
Oh, absolutely. That's the engine right there. Think about that rookie baseball player you mentioned. Makes $500,000 a year. Objectively rich.
Totally. Life-changing money for most people.
But maybe he's on the same team as Mike Trout, who signed that $430 million contract.
Suddenly, $500,000 feels not so rich.
He feels broke by comparison. It's all relative.
And it doesn't stop there, does it?
Not at all. Mike Trout, making $36 million a year. Maybe he compares himself to the top hedge fund managers. Back in 2018, the top 10 guys each made at least $340 million.
$340 million in 1 year.
Right. And those guys, maybe they look at the top 5 who made over $770 million each.
Okay, this is getting absurd.
It is. And even they can look up at someone like Warren Buffett. His personal wealth went up by, $3.5 billion in 2018?
$3.5 billion.
That's an amount that would take our rich baseball player making $500,000 a year 7,000 years to earn.
7,000 years. Okay, so the point is, the ceiling keeps going up and up.
It's effectively infinite. You can always find someone with more, which means trying to win at social comparison. It's unwinnable.
So the only way to win is not to play.
Pretty much. You have to just opt out, except that enough might be less than what the person next door has, and that's okay.
It reminds me of that Las Vegas casino dealer story.
Oh, yeah.
A friend of mine goes every year, asks a dealer, what games do you play? And the dealer says, dead serious, the only way to win in a Las Vegas casino is to exit as soon as you enter.
Ah, that's perfect.
And it's exactly the same with trying to keep up with other people's money, right? You got to know when to walk away, know when you have enough.
Precisely. Which leads nicely into, I think, the third key insight here.
Okay, what's that?
That enough is not too little. It doesn't mean being unambitious or, leaving perfectly good opportunities untouched.
Right. It's not about settling for mediocrity or playing it super safe all the time.
No, it's more fundamental. It's about realizing that the opposite of enough, that insatiable appetite for more, always reaching, will eventually push you too far. It leads to regret.
How so?
Well, think about eating. How do you know your absolute limit? You'd have to eat until you literally get sick.
Yeah, not pleasant.
Exactly. Nobody does that because vomiting feels way worse than any extra bite of food tastes good. The downside outweighs the upside.
Makes sense.
But for some reason, that logic doesn't always stick when it comes to business or investing. People keep pushing, keep reaching for more until they break.
Until they burn out or make a terrible investment decision or
like Gupta and Madoff end up doing something illegal because in their minds, every dollar is worth reaching for, no matter the cost.
That inability to say no to just one more potential dollar, it catches up to you. Turns potential gain into definite, often catastrophic loss.
After Gupta got out of prison, he told the New York Times something interesting. He said the lesson was, don't get too attached to anything, your reputation, your accomplishments, or any of it.
He said, I think about it now, what does it matter? Okay, this thing unjustly destroyed my reputation. That's only troubling if I am so attached to my reputation.
Wow. That sounds, I don't know, like a coping mechanism, like trying to rationalize away the loss.
It's easy to see it that way. Maybe the worst possible takeaway, right?
Yeah.
A way to feel okay about something that really isn't okay. Suggesting reputation doesn't matter after yours is, frankly, ruined by your own actions.
Yeah, because let's be real, reputation is valuable, massively valuable.
Absolutely. Yeah.
And so is freedom, independence, your family, your friends. Being loved by the people you want to love you, happiness itself. These things they're priceless.
Exactly. They are the things that truly matter. And your best shot, maybe your only shot, at keeping those invaluable things safe
Is knowing when to stop taking risks that could destroy them.
knowing when you have enough. It's the ultimate shield for what's truly important.
So understanding enough isn't just about money on a spreadsheet. It's about protecting your whole life, really, the things that actually make it worth living. Well said. It guards your freedom, your relationships, your peace of mind.
And the good news, maybe, the best tool for building that sense of enough. It doesn't require some complicated financial strategy or taking huge risks.
Not at all. It's simpler. It's more about perspective, about recognizing what you value and realizing that true wealth isn't just accumulation. It's also about knowing what you have and choosing not to risk it for something you don't truly need.
So maybe the final thought for everyone listening is, what does enough actually look like for you? What are those invaluable things you aren't willing to put at risk? Welcome to the Deep Dive. Today, we're taking a look at a really fascinating stack of sources you sent over. Articles, research papers, even some personal notes. And they're all grappling with this question, that we all think about. What really drives success and failure
Yeah.
in our finances, in our lives?
Yeah, and we love those simple stories, don't
Oh, absolutely. The lone genius, the innovator who just worked tirelessly, the bootstrap story.
Right, and then failure is just, oh, they made bad choices or they were lazy.
Exactly. But our mission today really is to unpack the incredible complexity behind all that.
It's true. We really look for those clear cause and effect lines, those tidy narratives. Yet, as these sources really show, every outcome in life is guided by forces other than individual effort. So this deep dive is all about those kind of hidden roles of luck and risk. They're so intertwined.
Totally intertwined. And actually, to kick us off, there's this great idea from NYU professor Scott Galloway, perfect for this.
Oh.
He says, nothing is as good or as bad as it seems. And you can think of luck and risk as like siblings.
Siblings, I like that.
Yeah, two sides of the same coin. Really, you can't actually separate them.
That's a powerful way to put it. These siblings, luck and risk, they're forces mostly outside our control, aren't they? But they just heavily influence where we end up. The world, as these sources suggest, it's just way too complex to think that 100% of what we do dictates 100% of what happens.
Right.
Sometimes those outside factors, the things we don't choose or even see coming, they can matter way more than all the careful planning we do.
So if they're that powerful, why are we, as humans so resistant to seeing it? Is it just needing control or?
I think it's a mix, definitely partly control, but also these forces, randomness, pure chance. They're just so hard to measure.
Yeah.
So hard to really accept. It's easier to just gloss over them. We prefer to think we're fully in the driver's seat. That our actions alone shape our destiny. It just feels better, more empowering, even if it's not the whole story.
Okay. Let's dig into this with a case study then. It really brings this stuff to life. We're talking about, one of the most successful people ever, Bill Gates. Now, obviously, brilliant guy, driven, visionary, all that.
Sure, no doubt.
But let's look at this 1 in a million head start he had.
Okay. This starts back in 1968. Gates is 13, attending Lakeside School near Seattle.
Right.
And the really extraordinary thing, as the sources point out, is that Lakeside was one of the only high schoolers in the entire world that had a computer back then. It almost sounds made up today.
It really does.
Yeah.
And how did they even get it? It wasn't like some big corporate donation or something.
No, not at all. That's the amazing part. It was a math and science teacher, Bill Dougal. He'd been a WWII Navy pilot, and he just had this foresight. He believed kids needed real-world experience, especially with computers. So 1968, he goes to the Lakeside School Mothers Club.
The Mothers Club, like bake sales and stuff.
Exactly, the ones who raised money from rummage sales. He asks them for just $3,000
$3,000.
to lease a teletype Model 30 computer.
That's incredible.
And it wasn't just any old machine. It was hooked up to a General Electric mainframe for time-sharing.
Which was brand new tech then, right?
Super new.
Okay.
Gates himself said time-sharing was only invented in '65. So Dougal was incredibly forward-looking.
So forward-looking.
And get this. Most university graduate schools back then didn't have access to a computer as advanced as what Bill Gates had in 8th grade.
That's just a staggering advantage. So what did he do with it? Just mess around?
Oh, no, he devoured it. He met Paul Allen there, and they basically lived in that computer room. Nights, weekends, learning everything. Allen even remembered Gates showing him a Fortune magazine, asking, "What do you think it's like to run a Fortune 500 company?"
Already thinking big.
That ambition, starting in that unique environment, that led to Microsoft. Now worth, what, over $1 trillion?
Incredible. So let's try and quantify that luck. Like you said, 1968. How many high school age kids were there?
Okay, globally, roughly 303 million.
300 million. Wow.
In the U.S., about 18 million. Washington State, maybe 270,000. Seattle area, a bit over 100,000.
And Lakeside.
Just 300 students.
So 303 million down to 300.
Yep. That puts Gates at roughly 1 in a million high schoolers worldwide who went to a school that had both the money and the vision to get that computer.
1 in a million.
And Gates knows it. He told Lakeside's graduating class in 2005, straight up, if there had been no Lakeside, there would have been no Microsoft. So yes, staggering intelligence, hard work, vision, absolutely. But he also acknowledges he had that 1 in a million head start.
It really makes you wonder, doesn't it? If someone like Gates, admits this huge slice of luck,
Right.
What about the flip side? What happens when those same random forces work against someone just as talented? And that brings us to Kent Evans.
Ken Evans, Bill Gates' best friend back in 8th grade.
Yeah.
And according to Gates himself, Kent was the best student in the class.
Wow.
Just as good with computers as Gates and Paul Allen. They actually built a program together to sort out the school's really complex class scheduling, and apparently it worked perfectly.
It's kind of striking hearing Gates talk about him, even remembering his phone number after all those years.
Yeah, 525-7851. He said he called him countless times.
And apparently, unlike Allen maybe, Kent had that same business drive as Gates, that endless ambition.
Totally. Gates remembered Kent carrying this big briefcase like a lawyer's.
In 8th grade.
Yeah, and always scheming, as Gates put it, about the future. Should we be CEOs? What kind of impact could we have? Generals, ambassadors, whatever it was, they figured they'd do it together.
They didn't.
No. Tragically, Kent Evans died, a mountaineering accident, before he even graduated high school.
Oh, man.
Based on everything Gates said, he could easily have been a founding partner of Microsoft right alongside Gates and Allen. Same skills, same drive.
And the odds there, they're just as stark, aren't they? Mountaineering deaths.
Yeah, incredibly rare, especially for a high schooler. Only about 3 dozen total mountaineering deaths in the U.S. each year.
So the odds of that happening to him specifically?
Roughly 1 in a million. Same odds, different direction.
Wow. 1 in a million luck for Gates, 1 in a million risk for Evans.
Exactly. That's the core lesson here, I think, from these sources. Gates gets the lucky break, Evans gets the unlucky one.
Right.
Their paths were so aligned, then just diverged completely. It perfectly shows how outcomes can be guided by forces totally outside our effort.
And they're so similar, those odds. You really can't believe in Gates's luck without also respecting Evans's risk.
You absolutely have to. They're two sides of that same coin, like you said earlier.
Which brings us back to how we process all this. We really do prefer to think success is all skill and hard work.
Oh, definitely.
And failure. Just bad decisions or laziness. It's cleaner, simpler, but dangerously incomplete.
It really is. You know, the Nobel Prize-winning economist Robert Shiller, he once said the thing he most wanted to know about investing but couldn't was the exact role of luck in successful outcomes.
Even he couldn't figure it out.
Right, and he said it's not just hard to quantify, it's almost seen as impolite to suggest someone's success involved luck. It kind of diminishes their effort in our eyes.
That makes total sense.
Yeah.
Like if I told you, okay, statistically, maybe 10 billionaires out there got there, mostly through pure chance.
You'd probably nod and say, yeah, makes sense statistically.
Right. But then if I asked you to name which 10?
Oof, Suddenly it feels, I don't know, wrong, demoralizing, as one source put it. We don't want to point fingers and say, you were just lucky.
Yeah, and this stretches into our economic lives too, right? There's that research by Bhaskar Mazumdar.
Oh, the study on brothers' incomes. Yeah, fascinating stuff.
Their incomes are more correlated than their height or weight.
Which points strongly towards shared upbringing, opportunities, the environment they grew up in, factors largely outside their individual control later on.
But the people who benefit most from that kind of start, they often deny it applies to them personally.
It's that bias again, isn't it?
And we do it to ourselves too. The double standard. Someone else fails, bad decisions, we fail. Oh, that was the dark side of risk, bad luck, circumstances.
Absolutely. We create these wild narratives, as one source calls them, to justify our choices when things go wrong, rather than just admitting, hey, maybe that was just random chance.
And Forbes magazine isn't exactly running covers celebrating investors who made smart calls but got unlucky.
Oh, no, definitely not. They celebrate the ones who made maybe reckless bets but got lucky. The outcome trumps the process in the storytelling.
Which is so dangerous when you're trying to learn. You see success, you see failure, and you think, okay, do what she did, avoid what he did.
But what if what she did was pure luck? And what he did was a perfectly sensible decision that just ran into bad risk? How can you tell?
You often can't, especially not at the time. That line between inspiringly bold and foolishly reckless, sometimes it's paper
A
thin.
millimeter thick, yeah.
Yeah.
And only visible with hindsight. Risk and luck are total doppelgangers.
Let's look at a few examples of this thin line from the sources.
Okay.
Like Cornelius Vanderbilt, building his railroad empire, apparently just ignored laws left and right.
Yeah, the story goes, his advisor warned him, this breaks the law, and Vanderbilt supposedly shot back, what do I care about the law? Ain't I got the power?
Right. And because he succeeded wildly, we look back and maybe call it sage wisdom or, aggressive strategy.
But the source asks a good question. How does society end up normalizing rule breaking after success validates it? Is that really a good lesson?
Probably not. And John D. Rockefeller, similar story, right?
Huh?
His tactics, a judge called him a common thief.
But historians often frame it as cunning business smarts. Again, the outcome colors the perception of the actions.
It really does. It shifts the narrative completely.
Then there's Benjamin Graham, the father of value investing, Warren Buffett's mentor.
The guru.
Right. But the sources reveal that most of his actual investment success came from owning a huge chunk of Jayako's stock,
That's right.
which, by his own rules, violated basically everything he taught about diversification.
Oh, wow. So he broke his own rules.
Massively. And even he asked, was that one lucky break or one supremely shrewd decision? And the killer question, can we tell them apart?
That really highlights it, doesn't it? The theory versus the messy reality, maybe involving one giant lucky outlier.
Exactly. And one more quick one, Mark Zuckerberg.
Turning down Yahoo's billion-dollar offer for Facebook back in 2006.
Right. Praised as a genius, he saw the future. Then Yahoo itself gets slammed later for turning down Microsoft's huge buyout offer. They should have cashed out.
So the exact same type of decision, turning down a big offer.
Is brilliant for one, terrible for the other, based purely on what happened next. It just shows how hard it is to judge those calls without hindsight.
Market timing, valuation. It's just so unpredictable.
It really underscores that doppelganger effect. Inspiringly bold, foolishly reckless.
Yeah.
Sometimes you just can't know which is which until much later.
Okay, so what does this all mean for you listening right now? Trying to navigate your own life, your finances. How do we find something useful in all this complexity?
Yeah, that's the key question, isn't it? Because the core problem, as the sources keep saying, is just how hard it is to untangle luck, skill, and risk.
It's a huge challenge if you're trying to learn how to manage money or really just make good life decisions.
Definitely. But there are a couple of recommendations, sort of shifts in perspective that come through in the sources.
Okay, like what?
First, maybe cultivate a bit more humility. Humility about outcomes.
Humility of outcome, okay.
Yeah, just recognizing that even your biggest wins probably had some good fortune baked in. And your worst losses might not have been entirely your fault. Maybe just bad luck.
There's that parent's letter to their son.
Oh, yeah, that was powerful. Not all success is due to hard work, and not all poverty is due to laziness. Keep this in mind when judging people, including yourself.
Wow, that really hits home.
It's crucial, that kind of humility. It means maybe you shift how you judge yourself, too. Not just by the result, but by the process.
Like, did I make the best call I could with what I knew then, even if the coin flip went the wrong way?
Exactly. Did you have a sound process? That's maybe more important than whether you got lucky or unlucky on any single outcome.
Okay, that makes sense. And the second recommendation?
Focus less on specific individuals, especially the extreme examples.
Like the billionaires and CEOs we were just talking about. Or the massive failures.
Yeah. It's tempting to study them, but their experiences are often the least applicable to most people's lives. They're outliers by definition. Their level of luck or risk is often off the charts.
So where should you look instead?
Look for broader patterns, general principles of success and failure that apply more commonly.
More. Average lessons.
Kind of, yeah. Think about that historian mentioned, Frederick Lewis Allen. He focused on the average median American, how they lived, what worked, what didn't over time.
Right.
There are probably more relevant, actionable takeaways in those broad observations than in studying the extreme outliers who grabbed the headlines. They might just be riding these wild waves of luck or risk that you'll never experience.
So less focus on the extreme stories, more on the common patterns.
Got it.
Got it.
Yeah.
So as we wrap this up then, let's circle back to that Scott Galloway idea we started with.
Nothing is as good or as bad as it seems.
Exactly. And Bill Gates had that quote too, right? Success is a lousy teacher.
Yeah, it seduces smart people into thinking they can't lose.
So when things are going incredibly well for you, maybe pause and realize, okay, this isn't quite as amazing as it feels.
Right. You're not invincible. And if you admit luck played a part in getting you there, then you absolutely have to respect luck's sibling, risk, because it can turn things around just as fast.
But the flip side is true too. Failure can also be a lousy teacher.
Definitely. It can trick smart people into thinking their decisions were awful when maybe it was just, the unforgiving realities of risk, as one source put it.
So the practical advice there when you're dealing with potential failure or risk:
arrange things, your finances, maybe other parts of your life so that one bad investment or one missed goal doesn't completely wipe you out.
Right. So you can stay in the game, keep playing.
Exactly. Have enough room for error, enough of a safety net so that risk doesn't take you out permanently.
So really, understanding this interplay of luck and risk, it can fundamentally change how you see everything, your own wins and losses.
And other people's too.
And maybe foster something we could all use more of.
Yeah.
Humility when we win, and resilience when we face setbacks.
Definitely. Think about how that shift in perspective could actually reshape the choices you make, your empathy, even your whole journey forward. Welcome to the deep dive. It feels like almost everything you read or hear about finance, it's always about getting wealthy.
Right. The strategies, the blueprint.
Exactly. How to make money. But what if the real skill, the one we don't talk about enough, is actually staying wealthy?
It's a huge distinction, isn't it?
Yeah.
And that's really what we're diving into today. Our source, it argues pretty strongly that, well, there are tons of ways to make money.
A million ways, yeah.
But maybe only one real way to keep it. And that's this combination of frugality and paranoia.
Frugality and paranoia. That phrase really jumps out because, we're often told, be bold, chase growth.
Yeah.
Why that combo? Frugality and paranoia seems almost defensive.
Well, it is, in a way, but it's about long-term defense. It's about managing risk, not just on paper, but in your head over decades. Frugality, it isn't just pinching pennies.
Okay.
It's about building buffers, giving yourself space so you're never backed into a corner, forced to make bad decisions when things get tough.
And the paranoia part, not like hiding under the bed.
No, not quite. It's more like active vigilance. Really understanding all the ways things can go wrong and building that into your thinking. Being prepared for surprises, not just hoping they won't happen. It's about resilience, really.
So our mission today is to dig into that. What does financial longevity actually look like? Not just a flash in the pan.
Exactly. Why survival isn't just one skill, but maybe like the ultimate financial skill.
And we're drawing on some really interesting insights from a financial psychology perspective. Lots of history, some counterintuitive stuff too.
Yeah, should be good. And to really get this idea, this difference between getting and keeping wealth, our source kicks off with this amazing historical story. Two guys.
Jesse Livermore and Abraham Germansky.
That's them, titans of their time, around the 1929 crash. They didn't know each other, but their stories, wow, they run in parallel and then just crash, literally, around that event.
Okay, let's start with Livermore. Born 1877, pro-stock trader. By his 30s, he's worth, like $100 million in today's money?
Yeah, a huge deal on Wall Street by 1929. Then boom, October 29. Black Monday, Tuesday, Thursday.
The market just tanks, loses over a third of its value in a week.
Total chaos. His wife, Dorothy, Apparently, she was terrified when he got home. People were jumping out of windows, you know the stories.
She probably thought they were ruined.
But Jesse, he'd done the opposite of everyone else. Genius, luck, whatever you call it. He bet against the market, shorted it.
So when it crashed...
He made a fortune. Comes home, Dorothy's distraught, and he says something like, "Nope, darling, just had my best trading day ever. We're fabulously rich."
Wow.
Made the equivalent of over $3 billion in one day. Became one of the richest men on earth while the world was falling apart.
Incredible, just staggering. But at the same time, while Livermore's celebrating, Abraham Jermansky.
Yeah, the other side of the coin, multi-millionaire real estate guy, made his money in the roaring 20s.
Like a lot of people then, he bet big on the stock market continuing to go up.
And it didn't. October 26, 1929, the New York Times reports he's just disappeared. Vanished. His lawyer basically said, yeah, he'd invested heavily in stocks.
Yeah.
And that's kind of where his story ends. Ruined.
So right there, the crash makes Livermore and breaks Jermansky. A stark contrast.
Absolutely. But here's the kicker, the part that really drives the point home. Fast forward just 4 years.
Okay.
Livermore. He's riding high from that 1929 win, feeling invincible, right? Starts making bigger and bigger bets. Gets massively into debt.
Oh, no.
And loses it all. Everything. And tragically, he eventually took his own life.
Wow. So they both ended up
in ruin. Different paths, different timing, but the same outcome. Our source puts it perfectly. Both were very good at getting wealthy and equally bad at staying wealthy.
That hits hard. And it's not just about billionaires, is it? This applies to, well, anyone trying to build anything financially.
Exactly. Getting money is one skill set. Keeping it, that's a whole different ballgame. Survival. That's the word our source keeps coming back to. Survival is the key.
Survival. It sounds so basic, but when you look at the stats...
It's brutal. Capitalism is tough. Right. Think about it. 40% of companies big enough to go public eventually lose pretty much all their value. Wiped out.
40%? That's huge.
Yeah. And the Forbes 400 list, the richest people, roughly 20% turnover every decade. People fall off. It shows just how hard it is to stay on top, to just survive.
And maybe that's because, like you said, the skills are different. Getting rich often involves taking big risks, right? Being optimistic, maybe a bit aggressive.
Totally. Putting yourself out there. But keeping money. Our source says it needs almost the opposite mindset.
Like what?
Humility, for one. A real fear, a healthy paranoia about losing what you've built. Frugality, definitely.
Yeah.
And, crucially, accepting that some of your past success was probably luck.
So you can't just expect it to repeat forever.
Right. Past performance is no guarantee, you know.
There's a great example of this, isn't there, from venture capital. Michael Moritz at Sequoia.
Oh, yeah. Fantastic example. Sequoia, they've backed Google, Apple, all these massive companies. Been around for decades. Well, most VC firms last maybe 5-10 years tops.
So Charlie Rose asked Moritz, you know, what's the secret? Why did you guys last?
And Moritz's answer wasn't about brilliant insights or finding the next big thing. He said, I think we've always been afraid of going out of business.
Afraid. Wow.
Rose pushed him. So it's fear. Only the paranoid survive. And Moritz was like, there's a lot of truth to that. We assume tomorrow won't be like yesterday. Can't rest on our laurels. Can't be complacent.
So it wasn't about being smarter. It was about being constantly worried about messing up. About survival.
Exactly. Just sticking around, avoiding the fatal blow. That's the foundation. And it connects directly to the power of compounding.
Yes, compounding.
Yeah.
The magic eighth wonder of the world, or whatever they call it. How does survival play into that?
Well, compounding needs one thing above all else. Time. Years and years for growth to really take off.
Like planting oak trees, the source says.
Yeah, perfect analogy. 1 year, not much change. 10 years, okay, something's happening. 50 years, it's incredible. But
you have to be there in 50 years.
You got it. You have to survive all the storms, the droughts, the unexpected stuff that happens along the way. If you get wiped out early, the oak tree never becomes a forest. Compounding needs uninterrupted time.
That makes sense. And when you think about someone like Warren Buffett, everyone talks about his amazing returns, how he picked stocks.
Right, trying to copy his stock picks. He didn't load up on debt. He didn't panic sell during, 14 recessions he's lived through?
14, wow.
He didn't ruin his reputation. He didn't marry himself to just one strategy. Didn't rely only on other people's money. Didn't burn out and quit.
He survived.
He survived. And that gave him longevity, investing from age 10 to nearly 90. That insane time span is what let compounding work its magic. Survival enabled the magic.
And there was that other guy, right, part of his early group, Rick Guerin.
Yeah, Rick Guerin. For a while, it was Buffett, Munger, and Guerin, kind of the three amigos of value investing.
So what happened to him? Buffett apparently said something telling.
He did. Someone asked Buffett years later, and he said, basically, Charlie and I always knew we'd get rich. We weren't in a hurry. Rick was just as smart, but he was in a hurry.
In a hurry? How did that play out?
Well, the 1973-74 market crash hit. Nasty one. Market down almost 70%.
Ouch.
And Rick was leveraged. He'd use margin loans, borrowed money to invest.
So when the market crashed...
Margin calls. His brokers demanded more money, or they'd sell his shares to cover the loans. He was forced to sell his Berkshire Hathaway stock back to Warren for under $40 a share.
Oh, painful. Stock that became worth millions later.
Exactly. So Guerin was just as good at getting wealthy, smart guy. But Buffett and Munger had that extra skill, staying wealthy, avoiding ruin.
Which, over the long haul, is what really matters.
It's everything. Nassim Taleb said it best. Having an edge and surviving are two different things. The first requires the second. You need to avoid ruin at all costs.
Avoid ruin at all costs.
Okay, so these stories make the why crystal clear, but how do we, actually do that? How do we build this survival mindset?
The source gives us 3 principles.
Yeah, 3 practical ideas. First one, aim for financial unbreakability, more than just chasing the biggest returns.
Unbreakability. I like that word. How does that lead to bigger returns, though? Seems counterintuitive.
Because being unbreakable means you can stick around long enough for compounding to work. You don't get forced out at the worst possible time.
Okay, like the example of holding cash. That feels like the opposite of maximizing returns, especially when the market's hot.
Right. Stocks are up 10%, your cash is earning 1%. Feels like you're losing. That 9% gap seems huge.
Yeah, it feels like you're leaving money on the table.
But shift your perspective. What if holding that low return cash stops you from panic selling your stocks when the market inevitably crashes?
Ah, I see.
Then the real return on that cash wasn't 1%. It was whatever catastrophic loss you avoided. It could be multiples higher than that 1%. Preventing one terrible mistake can be worth more than dozens of wins.
So unbreakability protects your long-term compounding.
Precisely. Compounding doesn't need huge returns every year. It just needs merely good returns sustained uninterrupted for the longest period of time, especially through the chaos. Survive the chaos.
Makes total sense. Okay, principle number 2. Plan on the plan, not going according to plan. Embrace room for error.
We all make plans, right? Financial plans, life plans, they're useful, they set direction.
But reality has other ideas.
Always. Think about the last 20 years alone.
Yeah.
Just unpredictable. 9/11, the housing crash, millions lost homes, then the financial crisis, millions lost jobs, then a huge bull market, then a pandemic.
Yeah, the unexpected is expected, weirdly enough.
Exactly. The unknown unknowns, that's just reality. So a good plan doesn't pretend everything will be smooth sailing. It builds in buffers.
That's the margin of safety idea.
Yep. Room for error. It's saying, okay, I hope the market gives me 8% a year, but my plan still works. I'll still be okay, even if it only gives me 4%.
So you're not fragile. You don't need everything to go perfectly right for your plan to succeed.
Exactly. So many bets fail, not because the core idea was wrong, but because they required pinpoint accuracy. Things had to be exactly right. Margin of safety protects you from that.
And it's not just being conservative, is it?
No, it's smarter than that. It's about increasing your odds of survival at a certain level of risk. And the cool thing is, the bigger your margin of safety, the less precise your predictions need to be. You don't need as big an edge to win.
It's like having airbags and seatbelts. You still drive, but you're better protected if things go wrong.
Perfect analogy.
Okay.
Third principle, develop a barbelled personality.
Barbelled, like weights.
Kind of, heavy on both ends. It means being optimistic about the long-term future, but simultaneously paranoid about the short-term threats that could stop you from reaching that future.
Optimism and paranoia together, that sounds like a contradiction.
It feels like it, but it's how complex systems often work. You need both. Be confident things will generally get better over time. The economy grows, innovation happens. That's the optimism.
Okay.
But also be acutely aware that the path there will be bumpy, full of setbacks, crashes, unexpected problems. That's the paranoia needed to navigate the short term.
So believe you'll reach the destination, but watch out for landmines along the way.
You got it. They aren't mutually exclusive. Think about brain development.
Okay.
By your 20s, you've actually lost about half the brain connections you had as a toddler. Half.
Pretty sad.
Sounds terrible, right? Destruction.
Yeah, sounds bad.
But you're way smarter as a 20-year-old.
Yeah.
That destruction was actually efficient pruning, getting rid of unnecessary stuff to make the remaining network stronger. Progress through loss.
Huh. Interesting. Never thought of it that way.
And the U.S. economy example is even more striking. Over 170 years, standard of living up 20-fold. Incredible progress.
Amazing long-term optimism, yeah.
But during that same period, 9 major wars, 1.3 million deaths, countless failed businesses, presidents assassinated, pandemics, natural disasters, 33 recessions, market crashes dropping by a third 12 times.
Constant reasons for short-term pessimism, even panic.
Constantly. Barely a day went by without some reason to be deeply worried. Yet the long-term trend was powerfully up.
So you need to hold both ideas. Be paranoid enough day to day to survive the setbacks.
So you can stick around long enough to benefit from the long-term optimism. It's hard, mentally. Our brains like simple black or white. Nuance is tough.
But essential for survival. And Livermore, he lost that balance.
Totally. His 1929 success made him lose the paranoia. He thought the good times would just keep rolling. Became overconfident. Swelled head, as he put it.
All right, he had that quote.
Yeah, about how no price is too high to learn not to get a swelled head. He called it an expensive disease everywhere to everybody. Learned that lesson far too late.
Financial humility, learn the hardest way possible.
The hardest way.
Okay, so let's wrap this up. This deep dive, it's really shifted the focus, hasn't it? From just getting wealthy to the often ignored art of staying wealthy. Survival is the name of the game.
Absolutely. It underpins everything else.
And those 3 principles seem key. Aim for unbreakability, not just big returns. Plan for things to go wrong. Build in that margin of safety.
Right. Embrace room for error.
And cultivate that barbelled mindset, long-term optimism balanced with short-term paranoia.
It's a powerful framework.
So here's a final thought to chew on. We talked about brain development, the U.S. economy, how massive long-term growth often involves, even requires, short-term destruction, loss, chaos, growth amid loss.
Yeah, that pruning, those setbacks.
What if that applies to you, personally, to your career, your projects, your own growth? What if the setbacks, the times you feel you've lost, the moments demanding that paranoia, what if they aren't just roadblocks? What if they're actually part of the process? Maybe even an essential, efficient part of clearing the way for your next big leap forward? What destruction in your life might actually be paving the way for something extraordinary? Okay, here's a strange one for you. What could the billion-year history of ice ages possibly have in common with growing your money?
Huh. It sounds completely unrelated, I know.
Right, like a trick question. But apparently the answer tells us something really fundamental about compounding.
Exactly. That's what we're digging into today. This incredible and often really counterintuitive power of compounding. We're going to pull lessons from these, seemingly very different fields.
Okay, so what's the mission here?
The mission is to show you these extraordinary results. Results that, honestly, our brains are just not wired to predict easily.
Logic-defying results, it says here. I like that. We're looking at sources connecting geology and finance.
That's the plan.
Yeah.
Unpacking these hidden drivers of success that often get missed because they don't seem dramatic enough at the start.
All right, let's do it. Where do we begin? Ice ages.
Yeah, let's start there. And it's kind of amazing how recently we even figured out the basics about our own planet. You know, Isaac Newton understood stars centuries before we really grasped Earth's geology.
That is wild. So ice ages weren't always accepted science.
Not at all.
Yeah.
It really wasn't until the 19th century that the scientific community generally agreed, okay, yes, the Earth has gone through multiple ice ages. Not just one, but 5 distinct ones.
And what finally convinced them?
The evidence just piled up. Things like massive boulders just sitting in fields miles from any similar rock formations, or huge areas of bedrock scraped totally smooth down to thin layers, things that only continent-sized glaciers could really explain.
Okay, so the evidence becomes overwhelming. 5 ice ages.
Right, and then you think about the energy involved. I mean, the sheer staggering amount of energy needed to freeze huge parts of the planet, then melt it all, then freeze it again multiple times.
Yeah, that's immense. So naturally, they thought it must be some huge cataclysmic event causing it, right?
Precisely. The first theories were grand, like maybe huge mountain ranges suddenly uplifted, changing weather patterns, or massive, prolonged volcanic eruptions blocking out the sun. They were looking for a cause that matched the scale of the effect.
But those theories didn't quite work out.